Well, holding out quite well. This is closing trades. We're a good 280 points up in green, and we're back at that 25,000 mark. And to think of it, the global handover from U.S. equity markets, at least on Friday night, because of escalated tensions between Israel and Iran, weren't the best. But this morning, it seemed like it's going to be at least calm to start off with, and then it's now perked up quite nicely. All sectors led by chemicals and cement, along with oil and gas, they are the ones which are powering up ahead. Within the benchmarks, it's HDFC Life, JSW Steel, SBI Life, Adani Enterprises, Ultratech Cement and BEL, which continue to scale up higher. And from the broader end of the market, KPIT Tech, Hindustan Copper, MCX, PI Industries and IGL are where you're seeing some meaningful moves come in. Tata Motors, it's recovered some amount of lost ground, but still down about 3.5% or so. Mazga Dock as well is seeing some profit taking. RBL and Dr. Reddy's are also laggards in trade today. Even Sun Pharma, actually, after those observations coming in on the Halol facility, that also, after a weakish sort of start, has covered ground and now trying to break into the green. But Kunal, hi afternoon. What is it that you're making of the market texture?
We discussed this in the morning, Aisha, that 24,900 should be a possibility for the index, given the way the markets have been poised, and especially I think at a point where the markets went to the end of the previous week on an extremely pessimistic note. Today's start was a little bit more jittery for the index, again reinstating the stance for many traders who probably have either booked out of their long positions or trimmed positions or cut leverage for themselves going into the weekend. But I think today, after the first half an hour, first 1 hour of that initial bit of volatility for the indices, post that we've actually seen very good built-up of open interest for indices as well as for individual stocks. Now, there are two important points which short-term traders should be looking at. One is that the India VIX is still settling back again to that sub 15 mark. Even with the thick of news flow surrounding the geopolitical arena, so that indicates that our markets are shrugging off the kind of negative news flow and indicating that we are into for a robust uptrend. And the second part is the advanced decline ratio. Even with a flattish 1:1 advanced decline ratio, the Nifty and the Bank Nifty have climbed up 1% to 0.8% respectively for themselves. So this indicates that there is more strength across the large cap names, and the mid cap and the small cap in the markets are yet to recover. So that indicates that this move is here to sustain, and we should build on over the next couple of days after this 200-point uptick on the index.
Okay, it's looking good for the index today. But Kunal, what about Nifty Bank? Because the entire banking financial space is also holding up pretty decently after the recent dip that it has seen. You have Nifty Bank that's up almost 0.6% right now, trying to catch up with the Nifty. What are you making of the financials and the banking space?
Yeah, this should be again a very strong up move yet again for the banking index. So earlier I think pre the RBI policy and just the next couple of days post that, we had actually seen the banking stocks financials do pretty well. Post that the indices went to a slight overbought territory. We went through 3 or 4 consecutive days of price correction for the banking index. But this could actually be a very good comeback for the Bank Nifty overall as such. But my also sense is that the financial end of the banking index, the NBFC pocket, the HFC, these stocks would actually do pretty well for themselves going forward. So I believe that the Bank Nifty overall should try and just about mirror or what happens to the benchmark indices, but the higher degree of outperformance could actually come back into the financial services pocket, specifically the NBFCs and the HFCs.
Okay. Kunal, any stocks one could work with? Like you said, financials led by insurance is the one which is gaining ground.
So Bajaj Finance, Finserv at current levels, I would believe that they are very attractive. L&T Finance after this negative news flow for the stock where it fell 5-7%, even the stock looks to be fairly attractive at levels of 189, 190. AB Capital, something which I've been highlighting, that's something which starts to look extremely attractive given the way the stock has recovered. So I think these are few odd names from the financial pack one can look at.
Okay, so that's on the stocks that Kunal is liking from the entire banking and financial space, or rather insurance as well. But another stock that's in focus today, that's Tata Motors. That's been the stock of the day for on the negative side today, because they for JLR, the company has said that their FY26 EBIT guidance is now at 5 to 7%. Remember, this is much lower than what the street was estimating, and also lower than their previous guidance of 10 They also maintain that their FY26 free cash flow is close to zero. Kunal, lots of trouble with the stock today. Only a handful of stocks in the red when it comes to Nifty, and Tata Motors is leading that list. What are you making of this stock on the charts? Because what would you advise to our viewers who bought the dip the stock saw, let's say around a year ago? What should they do now?
So I believe that sooner or later the negatives would start to get priced into the stock price, and we're seeing a 4%, 5% impact into the stock price, and given the way the markets are poised, it could actually be a matter of time that the markets the markets would shrug off the kind of negative news flow for Tata Motors, and it will not go into an extensive kind of a price correction. So yes, the impact could be initially that the price corrects by 5%. Then you see in a few odd days of divergence of the stock price with respect to overall auto index, or maybe for the overall market. So you may have a couple of days where the markets are doing very well for themselves and the stock may remain into a listless kind of a price zone. But then eventually the stock should try and make a comeback for itself. So I think with the slew of negative news flow coming for the stock price, the more the stock is trying to absorb this with less kind of a price impact for itself, indicates that sooner or later the stock would actually come back into a good buying zone. 670, 650 I believe could be a very good territory for traders who are looking to accumulate Tata Motors.
Okay, that's that on Tata Motors. But the one space which has propped up very nicely now, and perhaps a beneficiary of all that's going on between Iran and Israel, is the chemical sector. But before I take it across to that, let me quickly take it across to Shrishti and get in some more details on that JLR guidance which came about in the morning, because of which you're seeing such a hit on the stock.
Well, yes, the biggest contributor of Tata Motors, that is the JLR division, has come out with their growth outlook for FY26, where they have slashed their FY26 EBIT margin guidance by a significant number, which stands now at 5 to 7% versus 10% guided earlier. The company does cite that because of the fact that the US tariff threat is at play, the BEV transition, along with that the China growth market outlook, these are some of the key factors that are at play when it comes to the growth numbers, and along with that they have all the potential to hamper the EBIT margin performance as well, and hence the company has gone ahead and slashed their EBIT margin guidance to 5 to 7% now. Do remember that the 10% guidance was given back in 2024, where the company did share its long-term growth targets, and in the recent Q4 of FY25 earnings, the company did not come out with a very specific number, and they did highlight that they will be coming out with a detailed presentation on what is the growth outlook for JLR division. But they also highlighted that in the near term they were witnessing some slowdown and some weakness in the business sentiment as well. So that's one part. The other big commentary is coming in on the free cash flow number, because yes, for FY25 the company did guide for a free cash flow number to be turning positive, and bang on that the company did manage to meet those guidance as well and the targets there. And this time around for FY26 the free cash flow guidance is close to zero. So there was a bit of a sentiment building up, or rather the analysts were anticipating this number to turn positive, but the company is guiding for a number close to zero on that front. But for FY27 and 28, they have highlighted that they foresee a year-on-year improvement going ahead as well. In terms of the capex, that number stands as it is. 18 billion pounds is what the company committed for their reimagined strategy by FY28, and no changes there. So all in all, that's the latest update coming in on JLR front, where the company has cut down their EBIT margin guidance for FY26 by a substantial number.
Right, we'll leave it at that. In fact, let's also throw light on, some of the macro data points. And the trade data came out for the month of May. The fact that the deficit has now narrowed to $21.88 billion for the month of May. There's been an uptick of 2%, which one has seen, or rather slip actually, of almost 2% that one has seen in merchandise imports, and the services imports and exports have actually risen. Though there was decent merchandise exports growth that one saw in the April to May time. We will take it across and get in some more views on that in just a bit from now. But in the meantime, looking at the texture of the market, and the one space which has really been holding out, and we should get the sound bites up from Ajay Joshi, the Indian chemicals expert, and the chat that we had with him earlier today. Kunal, what's it that you're seeing right now on the likes of PI Industries, for instance, that's been holding out well, and the entire chemical space is abuzz quite a fair bit today.
Yeah, in fact, many of the stocks are actually nearing multi-year breakouts. SRF is one of them. PI Industries is not exactly closer to lifetime high levels, but I think at almost at 8-month to 9-month high for itself, trading above 4,000 plus mark. Camlin Fine Science is one of the stock which I think is trading at a lifetime high levels. You've seen very good recovery coming out for Atul Limited. I think at 7,200 plus levels where the stock is trading. Aarti Industries. So there are many stocks which are actually showing signs of not just recovery for themselves, but some of them are perched at multi-month, multi-year highs for themselves. So I think that's a very encouraging sign for the entire sector, and this indicates that we are looking at a point where the entire sector may go into a much more huge and a bigger upside for themselves. So would be very bullish on the entire specialty chemical space. Very difficult to pick and choose just one or few stocks, but I think it's better that one makes a basket of stocks, including the likes of SRF, Camlin Fine Science, etc.
In fact, here is the soundbite from independent chemicals expert Ajay Joshi talking about the ongoing conflict between Iran and Israel, the fact that oil prices have shot up, and how it actually impacts the Indian chemical sector back home.
This ongoing conflict plus the Strait of Hormuz, which Iran has almost banned, the supply chains of crude oil and natural gas would also get affected. So this means for the world is that oil prices would shoot up. And when crude oil prices shoot up, inadvertently the chemical prices, because they are derived from the crude oil, that would also shoot up. So this means that the raw material cost would increase, the input cost would increase for Indian chemical producers. One such chemical is, of course, methanol, which around 15 to 20% of India's methanol import, they do come from Iran. So now we would have to look out for alternate supply source. So companies like Balaji Amines, companies like Alkyl Amines, then companies like Aarti Industries, which use methanol to make downstream derivative intermediates, companies like Jubilant Ingrevia, which use methanol to make pyridine, which is their key starting material, because they are a full-fledged pyridine player. So these are some of the big consumers of methanol in India. For acetic acid, the biggest two consumers are again Jubilant Ingrevia and Lakshmi Organics. So because of this conflict, I do see the input cost, the raw material, the cost of manufacturing cost going up this particular quarter for Jubilant Ingrevia and Lakshmi Organics particularly, and also for the amines companies in India particularly.
Okay, let's try and understand and make sense of all that's happening in the world right now. We've got Vivek Paula, Head of Portfolio Research at BlackRock Investment Institute, joining in on the show right now. Vivek, hi, welcome to ET Now. Thanks for joining in. Vivek, history's told us that wars do happen and the markets also climb the wall of worry. Is it any different this time?
It's always impossible to guess the near-term news in environments such as this, as you say. But as I think one of your previous speakers outlined, I think the thing to watch is around energy prices, oil prices. And that's something that has moved materially in the course of recent days, something like 10 to 15% in the course of the last week. Whether or not that has a more longer lasting impact on the global economy will very much depend upon the longevity of the conflict and indeed the spillover effects. But I think oil is what to watch.
On the flip side, do you think the tariff uncertainty is abated, or do you think the markets are still a little bit on tenterhooks about that?
I don't think it's abated, and I think we should anticipate this to be the new normal. We're in an environment where macro uncertainty is just structurally higher. And indeed, it's impossible, again, to my earlier point of trying to guess the next blow by blow in the tariff dynamic. What we should consider, though, is more the broader sort of impacts around this. And markets have played some element of a stabilizing role in the course of the last couple of months. Whenever we've seen extreme moves, we've seen actually market forces dictate a kind of shift. So, for instance, think about the fact that the US has very much reliant upon foreigners for the funding of its debt. Think about the interconnected nature of global supply chains. Whenever we push extremes in market pricing, that leads to automatically, I guess, some element of a shift in that policy stance. So I don't think it's behind us. What I would say is actually, moreover, the macro data is probably yet to fully reflect the impact. So even in an environment where, let's say, we have certainty from now on, we're yet to see that come through in the macro data. Recent macro data in the United States points to some of the growth impacts sort of playing out. We're seeing some element of small contraction in terms of the quarterly figures. We've seen some element of a slowdown in CPI, but it doesn't yet reflect the full impact because companies are yet to make decisions. They're holding off on account of uncertainty.
But Vivek, given that, the world is in so much flux on not just geopolitics, but, the repercussions and bearing of it all on the economics as well, what happens to longer term money? Would you say that US is not the most preferred destination in the long haul as well? Or do you think that view doesn't change?
Well, we've got an overweight to US assets in our sort of 6 to 12 month horizon tactical views. And it's led by the idea that AI as a structural megaforce will continue to dominate the global environment for a period of time. And the US has many of the best companies in that space and is really well placed to take advantage of that. And when I look further afield, when I look to the longer term, we need to start from the current environment that we're in. The US is the dominant economic player, and it's hard. It's hard. We've seen this in recent months. It's hard to massively change the shape of the global economy in a short space of time. So we'd anticipate US assets to continue to play up the bulk of investor portfolios. But in the long run, undoubtedly, no one can have certainty here. There's a much wider range of potential outcomes than there ever has been before. Long-term macro anchors that we've built asset allocations around for the last 30, 40 years are being more challenged. So I think the idea is that we should start by thinking US assets will play a sizable role and will continue to do that. But we need to acknowledge, as you've said, that the range of uncertainty in the long run is just unprecedentedly high.
Interesting that you say that earnings eventually are going to be backed by AI-driven earnings. That is, if one can, term them as that. Other than AI, Vivek, then, what do you think are going to be the driving mega forces that will dictate which way money is going to move across the globe?
Well, AI is one that I've already sort of highlighted here. This has probably been the dominant market story of the last couple of years, and it's got some competition, as I'll go on to, but it's been the dominant market story because this is transforming the global economy. It's shifting the way in which we interact with products and services, and it will have impacts immediately in technology, but it will have much wider lasting and wider impactful impacts across the broader economy. But it's not just AI. Geopolitical dynamics, we talked about that earlier. That is another mega force that is transforming the global system. The idea that the way in which we produce things across the world are shifting. India, I think, is a net beneficiary of this. The idea of, if you like, a China plus one type sort of strategy in terms of export chains because of the dynamics between the US and China is something that structurally benefits India. Another thing that does is demographics. Demographics is another structural megaforce which for much of the developed world, indeed for China, is actually acting as a drag on growth. For India, it is the opposite. So here's 3 examples, I guess, of structural megaforces that cut across just regional dynamics. They actually play out in terms of sectoral dynamics and these themes. And I think that's the way in which we need to make asset allocation decisions going forward.
Okay, point taken. Vivek, hi. We also understand that you're positive on Japan. Help us understand what drives this confidence, because we are understanding, we're talking about the shift in geopolitics and how emerging markets stand again. But what about Japan?
Japan is another area that we think is a benefit structurally from the shifting environment that we're in. For the first time in a long time, we have inflationary dynamics that are on the positive side in Japan. We're seeing sort of a shift in sort of corporate reform. We're seeing a reawakening of the Japanese economy that has not happened for many, many years. And it is poised to structurally benefit from some of the shifting dynamics that we're talking through. So for a long period of time, we were in a stagnant growth, stagnant inflation environment in Japan. We are seeing a shift in that, and we think that actually that will attract foreign investor flows in the course of the coming years, and that's part of the reason why we remain overweight. So in our longer run portfolios as well, not just our shorter run, we'd hold a greater allocation to Japanese assets than a benchmark might suggest.
Right. Vivek, where does China fit into the scheme of things? The data points there definitely are looking up. Tactical money has been long China since the start of the year. But what about long-term money?
Well, for a period of time now, we've had a neutral view around China in the ultra-long horizon. It's not an asset that we particularly call out in our longer-term strategic views because there are some structural growth dynamics that are at play in that country, and continue to be so. If we look at the impact of geopolitics that we talked about a little bit earlier, actually China is particularly impacted by the dynamic and the evolving trade rhetoric that's going on globally. If you look at the China sort of trade dynamics, the exports to the United States just in recent months, it's materially fallen relative to where it has been for most of the last decade. So it clearly is having an impact there. What China's doing is it's reorienting its exports to other parts of the global ecosystem. So, for instance, broader Asia. And I think we'll need to kind of wait and see how that plays out. But from the perspective of an overseas investor, if you think about the Europeans, if you think about the Americans, investing in regions, investing in countries in the broad sort of Asia Pacific region, actually we think for us, India stands out much more than China for some of the reasons we've mentioned. And if I look at the flows in recent months, actually that is really backing this up. We've seen that some strong sort of flows of foreign investment back into the Indian economy as a result of, I think, this idea that there is structural opportunity in India. And I think that's where foreign investors will play more in the future than in China.
Okay, so that's the take. And you also spoke about India, but Vivek, what's your view on the treasury yields, the bond market in India as well as US? Because we understand that you're long on equity, but not looking that positive on bonds.
Yeah, and I think it's really interesting to think about the recent sort of shock to financial markets with the geopolitical tensions over the last few days in the context of that view that we have on bonds. Traditionally, there's an element of a safe haven status that treasuries play in an environment such as this, and there's a fall in yields as a result of dynamics such as global macro tension. That is not what we're seeing. We're not seeing that for two reasons. We're not seeing that because of the potential inflationary pressures. I think we talked about that earlier. That's yet to fully reflect in the economic data that will have upward pressure on yields, but also the way in which the market is pricing the risk around US treasuries is different. For long dated assets, it is no longer seen automatically as the risk off, because it does indeed have its own risks. We've been saying for a while that term premia, or the compensation that investors demand for holding long dated debt in the US, needs to go up to reflect some of this. And that's not because we think term premium needs to get particularly wide from historic standards. It's just that for the last 10 to 15 years, it's been really compressed. And there needs to be a normalization of that in the US Treasury market before we get getting to levels that we find attractive from a yield perspective. When it comes to India, I think there's less of a strong directional view. But what I would say is, if I look at the yield curve today, compare it to what I'd anticipate it to be in the future for India, it's not that dissimilar. So as a result, there's a relative preference for Indian government bonds relative to US government bonds in the long run, because we think US government bond yields need to appreciate from here, rise from here, which is a valuation loss for a holder.
But Vivek, what about Indian equities? Is there valuation comfort and earnings visibility? Or do you think in this flux that the world is seeing right now, India is bound to be impacted? And I'll tell you why I ask, because, at least the macro data points seem to be quite supportive. You've got inflation under control. You've got a significant interest cut by the central bank as well, and very accommodative at that. So, that definitely is going to give a fillip to consumption.
I agree, and that's why we call out India as a structural strategic overweight in the asset allocation that we hold. So from a long-run perspective, we'd hold a greater share of Indian large-cap equity than the market benchmarks would suggest if you're an international investor, and it is due to a number of these factors. We've not been making the case on the shorter run horizon up until now, for the reason that there are some sort of tactical or nearer term headwinds that the central bank clearly is reacting to make that policy more accommodative. But the long run picture continues to be attractive for the reasons I've said. And I think you talked a little bit about valuations earlier. One of the things that has been mentioned in context of Indian equity valuations for a period of time is that if you just look at price earnings ratios and compare them to the past, they don't look necessarily that attractive. But we take a slightly different view. When we're looking at it and we're trying to sort of ascertain the gap between the risk premium associated with Indian equities, the earnings potential of Indian equities, and if we account for the fact that the earnings potential might be greater than we've seen in the past, the risk premium doesn't look that elevated to us. So we would find actually Indian equities broadly reasonably valued right now, and therefore with that earnings boost that is likely to come from the structural mega forces, this is for an investor who has a longer run holding period, a good time to invest in Indian large cap equity.
Vivek, and very quickly before we let you go, your long-term conviction as well as your conviction for the next 6 to 12 months, where does that lie?
Yeah, well, I think we've talked about a lot of this already. In the next 6 to 12 months, we'd call out US equity, we'd call out Japanese equity, we'd be cautious around the role of long-dated US government bonds. When I look further afield into the strategic horizon, we'd call out India. We'd call out, for those investors who can access private assets, we think there's large diversification potential, idiosyncratic return benefits that would benefit an investor too. So there are some of the kind of key things that we're looking at when, in the long run, particularly infrastructure, I think makes a lot of sense right now.
Okay, hold that thought. We have a time-bound commercial we need to slip into, but I have lots more that I wish to ask you on the research BlackRock Investment Institute, who stayed on with us very kindly. Vivek, thanks so much for staying on. And now I want your view on what you're making of the surge that we've seen in gold. The kind of run-up that we've seen over the last couple of months for gold has been unprecedented. Would you still be long on gold after the run-up, or now do you believe silver could be the next gold in the making perhaps?
Well, I think when we're thinking about gold, we've got to really understand why is it? What's been driving that kind of demand? Because on the face of it, you think, well, actually, given bond yields are now returning positive territory in the developed markets, it's not obvious why gold automatically rises in that environment. It's really linked to the conversation we're having the other side of the break, which is to do with the fact that the role of traditional diversifiers is shifting. Traditional diversifiers, such as, for instance, the US dollar, such as, for instance, the treasury market in the United States, are losing their appeal in the near run. We think for the treasury market, as I've said, there is a reason for that will continue for the foreseeable future. And in that environment, when investors are worried and when there's sort of uncertainty in the broader system, gold is something that makes increasing sense for those with a shorter horizon look through. And that's why we've been advocating taking that allocation position too. I think what I would say when I look forward, clearly with the ramp up in prices and clearly with the fact that this is uncertain an environment, we shouldn't necessarily think uncertainty means bad. And I think that's one thing that we need to kind of account for. Uncertainty means uncertain. It means that there's a possibility of positive scenarios from here, the possibility of negative scenarios from here. So undoubtedly with the ramp up in gold, we need to kind of look at that positioning and think whether or not it makes sense in the context of everything we would advocate. We would continue to say, though, net, as of today, let's make sure that we are using gold more as a diversifier than some of those other traditional diversifiers in the near run.
Okay, Vivek, and before we let you go, also give us your sense on the central bank action. We have 3 major central banks that are going to be mulling their stance, their rates this week. Now, largely, while all of them were expected to keep their rates unchanged, do you believe that this escalation that we've seen in West Asia could change any of that?
I think the expectations, as you say, is for not material action, and I think that will be the case regardless. And I think, the escalation that we've seen more recently is something that will give them pause for thought and indeed factor into longer run decision making. But I don't expect it to materially change the course of what they were going to do anyway. So we don't anticipate major moves over the course of the coming week in terms of major central bank action. In the longer run, we'd anticipate that, yes, the path is likely lower, but at a comparatively gradual rate on account of some of those inflationary pressures continuing. Whether or not that's accentuated by the recent conflicts remains to be seen, but we think the path down is comparatively gradual.
Okay, Vivek, really appreciate you staying on and sharing your views with us. Thanks so much once again for joining us on ET Now. On that note, we'll let you go. Well, let's move away from that conversation. Lots of insights coming from that conversation with Vivek Paula of BlackRock Institute. But let's also take a look at what the markets are doing. doing right now. About 20 minutes or so left of trade today. You have Nifty that's very close to that 24,950 mark, almost at the day's highest point, looking very good, almost a 1% uptick coming in for Nifty. Similar for Sensex, 0.8% uptick coming in, 81,800 thereabouts is where the Sensex is right now. Nifty Bank too not lagging too much further behind, 0.7% uptick coming in for Nifty Bank. Let's see what the broader markets are up to in today's trading session as we speak. Midcap has gained some solid footing ever since the get-go. 0.9% higher, absolutely in tandem with the Nifty is where the mid-cap space is right now, and small-cap also, in fact, outperforming the market as usual, as the small-cap index almost always does. A 1% uptick coming in on the small-cap index right now as well. Only a handful of losers on the Nifty losing side: Tata Motors, Dr. Reddy's, Adani Ports and Sun Pharma. On the flip side, it's BEL, Ultratech, SBI Life, HDFC Life. So it's really these insurance stocks that are doing very well in today's trading session. We now have Nishchal Maheshwari, market expert, also joining us on the show, and Kunal is of course with us as usual. But Nishchal, hi, good afternoon and thanks for joining us. I'll come to you first and give us a sense of some of these insurance stocks that are buzzing in trade, the likes of HDFC Life, SBI Life. They're some of the top Nifty gainers today. Are you positive on the insurance space, and if yes, which pockets are you liking at the moment?
Good afternoon. Thanks for having me on the show. I think insurance, if you really look at it for the last 4 or 5 years, really have underperformed. So if you otherwise, if you look at from the penetration point of view, I think India is hardly penetrate 10 or 11% Indians own insurance. So I think there is a long way to go for a long runway for the Indian insurance companies. Unfortunately, I think till now, most of the insurance companies have more market related products rather than actually pure insurance. I think, but that is changing, and that's why we are seeing some interest coming back. But in this background where they've underperformed quite a bit, basically, I think that's where the interest remains to be. And personally, I like the life insurance space, and SBI Life and LIC, both of them because of attractive valuations.
Okay, so that's the take on the entire insurance space. Kunal, what are you making of this oil and gas space that's really buzzing today? Something like an IGL is up 6% as we speak. You have HPCL, ONGC, BPCL, IOC, all of them are doing well. In fact, one of these names was even your pick for the day. Give us a sense of what you're making on this entire space right now.
And it's exactly the point, Sneh, because at crudes at $75, $80, you generally expect that the oil marketing companies would actually go into a dizzy in terms of a price correction, but you've seen a different kind of a price action for these stocks altogether, and that tells you that the markets have moved beyond the kind of news flow which has been surrounding. I would believe that we are looking at a point where the oil marketing companies would continue to move up on a higher basis from current levels. You're looking at Oil India, IOC, for example. That's a stock which has been holding on to a good support point closer to that 140 mark. The two names which have given a breakout, ONGC, I think today, for example, the stock has given a classical breakout, ending almost like a 2.5 or 3 months of a major consolidation, and it's almost like a 15 to 20% consolidation for ONGC breakout about the 250 mark. So that's another interesting name to look out for. Oil India, I think the bounce back from its 200 moving average and the support the stock has taken, I think that's also making the charts a lot more attractive. So which means that we are looking at a point where the market texture is not just changing quite dramatically, but even with the slew of data points which ideally should have had a negative price action, our markets and the stock specific price action has been a lot more positive there.
Okay, so that's the take on the entire oil and gas space. We also have Aditya Agarwala joining us on the show, head of research and investment at Invest4Edu. Aditya, hi, good afternoon and thanks so much for joining us. First off, give us your sense on what you are making of the market move today, given that we've seen only consolidation over the last week or so, and today such a big spike coming in the market. How sustainable is this on the charts, and do you only believe this is on the back of fundamentals, wherein you have some good news coming in, at least in terms of India's macros? But other than that, what do you think of the kind of trading day we've had today?
Hi, afternoon, Sneh. I think market's still locked in a range. Nothing much to read about if I talk about Nifty per se. On the upside, again, 25,100, 200 continues to act as a major hurdle for the Nifty. On the downside, 24,500, 24,400 continues to remain as a support area. What is interesting is you have a lot of news flow, geopolitical tensions creeping in every now and then, and markets do give up on one day, and then it recoups all its losses and again comes back into consolidation. So if you take a look at the overall texture of the market, I think it's more of digesting the negative news in the markets and still holding on to the positive territory. So that is important. Over a period of week, I think markets will continue to oscillate in this zone 25,200. I don't think so will be taken out that easily. And on the downside, 24,500, 24,400 shouldn't break that easily as well. Within that range, I think sector churns will continue to happen, which we've been witnessing for past 2 to 3 weeks, and that is likely to continue in the coming trading sessions as well. I think some banks which had been underperforming for past couple of weeks can take leadership now. Some of the large cap private sector banks, they need to be looked at, names like an Axis, an ICICI or a Kotak Mahindra Bank. They can actually start seeing some kind of a short covering rally and a fresh long build-up as well. Apart from that, you have the usual sectors which continue to outperform. The defense, I think, has made a comeback in trade today. That is likely to continue in the next few trading sessions. Real estate, I think that is also likely to continue inching higher in a couple of next trading sessions. And along with that, I think auto components, which had witnessed some kind of a selling pressure in the last week, is likely to make a comeback and also head higher. But apart from that, I think so banks is something which hasn't been participating yet, and that needs to participate. And I think so this week could be a breakout week for Bank Nifty and the banking stocks.
Like a breakout week for the financial space, including banking stocks. But sources tell your channel that Oil Ministry has once again pitched for natural gas to be included under GST, and the ministry has approached Finance Minister to build consensus on the same. Let's take it across to my colleague Prakash for more exclusive details on this. Prakash.
That's an important development coming in, as we are learning from our sources that the Oil Ministry has once again pitched for inclusion of natural gas under GST. We're given to understand that the ministry has approached the Finance Ministry to build consensus over the issue, as inclusion of natural gas under GST is crucial for bringing clarity to the sector's taxation system. Along with that, ministry also believes tax clarity is essential to achieve the gas consumption target by 2030, as overall domestic demand is expected to grow on the back of CGD sector's expansion. Therefore, bringing natural gas under GST would be crucial, as it will ensure price affordability for the CGD sector. Along with that, Prime Minister Office is also involved in the consultation process. Inclusion of natural gas and ATF under GST will be implemented in phases. However, states were not in favor of discussing the proposal in December 2024 GST Council's meeting. Let's see how it pans out. Will the Finance Ministry bring proposal? But the Oil Ministry at this point of time has once again pitched for inclusion of natural gas under GST.
Okay, Prakash, thanks for all of those exclusive details. So we understand from Prakash's sources that Oil Ministry has asked for CNG to be included, natural gas to be included under the GST ambit. Nistal, if this were actually to happen, how would this pan out for the entire oil and gas space? Could this be seen as a positive, or do you believe a fixed tax bracket could be detrimental to this sector?
Oh, definitely, I think it will be positive for the sector, especially the gas companies. But I think what worry remains to be is basically how it's going to be impacting the tax collections of the government. So that is the major issue basically, and that's why I think it's getting delayed. So I'm not quite hopeful that it's going to get taken up and getting implemented.
Okay, so that's the take on if natural gas gets included under the GST ambit, and of course we'll be bringing you more details as and when we have them. But Kunal, coming to you, I can't help but be very happy at the kind of market move that we've seen today. A good shade of green coming in after so many days in the red. I'm going to be a little optimistic and ask you, how far do you think a new high is for our Nifty?
I think it should be pretty soon for the index. Purely the reason for that is that the shock absorption capacity for the indices, and whenever we've seen that the markets have this absorption capacity where the news flow becomes a lot more negative, but our markets tend to make a comeback. You look at the kind of stocks, large cap names specifically, and the news flow for these stock prices for these stocks eventually. So and for example, there was negative news flow for stocks like Tata Motors. There was something for the many of the other sectors as such. But the way these stocks make a comeback eventually in the next couple of days indicates that the markets are looking at a much more bigger upside potential for many of these stocks. And I believe that's the hallmark which one has to look out for. So we generally look out for behavioral analysis of the markets and how the markets react, stocks react post a slew of negative or positive news flow. This time around, the markets have been a lot more resilient market, even with the kind of negativity thrown not just on an overall geopolitical basis or a global news flow basis, but even stock specific or news specific for individual companies. That I believe is a very strong telltale sign that we are looking at a potential that this market can climb the wall of worries and move up significantly higher. Wouldn't be surprised that potentially, just to give it a guess, maybe the next 3 to 4 weeks, we could be looking at an all-time high for the index or very close to that 26,000 mark for the Nifty.
Sounding very optimistic, and we're all looking forward to this if it actually does happen. And here's hoping that the next 3 to 4 weeks we're seeing a new high on the Nifty. But Aditya, what about you? Do you concur with that view? And if so, where would you be placing your bets? Any stock-specific ideas that you would want to share with our viewers today?
There's a possibility. I don't rule that out, that markets can hit a new all-time high. But I'll give it some time. I still feel markets are still locked in that range, and it will take some time and effort and something for markets to break out of that range of 25 200 to about 24 400 that we just spoke of. But yes, the undertone of the market remains strong, and like I mentioned, sector specific, stock specific actions continue, and that is likely to continue. There's no denying it in that. So there is no weakness in the market per se. There is strength, enormous strength in the market. Having said that, I think one space which is looking very interesting to me is the diagnostics space and the hospital space. So Apollo Hospital for me stands out. That is one stock that I would be a buyer in. Look for a target of 74.50, the first one, and if that is taken out 7600, it can also be a possibility here. Place a stop loss somewhere around 69.70 on the downside. The second is Voltas. Now again, we've seen stock go into some kind of a consolidation phase after a correction. We're witnessing fresh breakout in Voltas, and volumes are also supporting that breakout. So at current levels, I'll be a buyer in Voltas for a target of 14.50 on the upside. Place a stop loss somewhere around 12.60 on the downside.
Okay, so Apollo Hospital and Voltas looking good to Aditya right now. Kunal, what about you? What are some BTST trades that you would like to recommend to our viewers?
So I'll go with two buy calls. Grasim is the first one which I would recommend as a buy. I think it's an interesting comeback after 3 or 4 days of a negative price trend. The stock almost engulfing the last 3-4 days of a negative price tick, and with today's price action move, that I believe is extremely positive and indicates that the stock is nearing a potential decent breakout for itself. So buy with a target of 27.80, stop loss at 26.80. The second is a buy in Policy Bazaar or PB Fintech. Again, a very interesting chart. The stock bounced back from its 200 moving average, completing a swing breakout, as well as a more or less like a bullish flag formation on the daily time frame chart. So we'd look out for 1980 as a target for PB Fintech, stop loss at 1880.
Okay, so those are the stocks that are on Kunal's radar right now. But Nishchal, what about you in terms of sector-specific action? We've seen enough sector churn happening in the consolidation that we have seen over the last couple of weeks. It's been the day or the week, or you could even call it the month of IT, realty. You have metal that's trying to break in over there as well. Do you believe that this sector domination, if we could call it that, could continue for a couple of these sectors in the near term as well, or do you believe that another sector churn is just right around the corner for us?
Is that question for me?
Yes, Nishchal, for you.
So I think banking will still drive the whole rally up basically, because I think there is a lot of way for banking BFSI as a sector to go. This rally has been led by banking, and I think that will still continue to drive it. IT has turned around, so I believe IT is going to be another one. And among the smaller sectors, basically, I think pharma and cement are the other sectors basically which I like. The broader theme still continues to remain is basically there is an interest rate cut happening, and all the interest rate impacted stocks positively basically, which are both BFSI, cement, all these sectors are positively impacted by the interest rate cut, so they will be beneficiary. So the broader theme remains to be interest rate cut theme has to be played out.
Still more of that interest rate cut theme that still needs to be played out is the view coming in from Nishchal. But Kunal, can't help but notice there's a new player that has joined the others in the all-time high list today, and that's Motilal Oswal, MOFSL as we know it. What are you making of this stock on the charts? It's been steady, but today is the first time that we're seeing it join some of these names that we're talking about constantly, the likes of Muthoot, Manappuram, Karur Vyasa. They've been in this all-time high list for quite some time, but MOFSL, new candidate there.
Yeah, new candidate there, and potentially I think the stock should continue to look fairly attractive. So what we've seen over the last few weeks, there was this point where there was a space for many of the capital market companies or the stocks which had actually done very well for themselves. So I think in that space we've seen many of the stocks showing price volume breakout on individual time scales, whether it was daily charts, some of them it was the weekly and the monthly charts. So I believe that that's a very interesting prospect for the entire sector, and this indicates that even after maybe few days of an odd consolidation or a price correction, these stocks have a capacity of making a strong comeback for themselves. So is the case with stocks like MOFSL, Angel One, etc.
Okay, so that's the take on MOFSL on the charts. But Nishchal, want to talk to you about the pharma space. Of course, this space has been in focus today. It's been a buzz. We've seen some very negative action coming in for Sun Pharma. Halol facility once again has received 8 observations from the US FDA. On the flip side, you have Syngene that's received no action indicated for 2 of its facilities. It's looking good for that. You also have a Natco Pharma that's received 1 observation. So lots of news flow for pharma today. Where are you placing your bets amid this sector? Because US FDA action continues for something like a Sun Pharma.
I think as far as Sun is concerned, it's a very old case. I think the case is from 2015. That particular halal facility continues to be remained there. And I think they have not been able to sort it out. So it's almost some 8-10 years now that facility is not got sorted out. But from the broader space in pharma, I think 2 spaces I like. One is the CRAMS facility, the CRAMS business. And there are several of them. Basically, you have highlighted Syngene, you highlighted Natco, Laurus. These are some of the stocks basically which have done pretty well. Divi's is one of them. So I'm saying that is a space basically which continues to do pretty well. And that space is, I think, a long way to go with the China +1 policy. The second space is the domestic one, which is not exactly pharma, but the hospital space. I think that is also doing pretty well. So these are the 2 spaces within the broad spectrum of pharma plus healthcare. I think these are 2 spaces which I like.
So that's how Nishchal would place his bets in the pharma space. But, well, only a couple of minutes left for market close. And Aditya, before we let you go, give us a quick sense on what you expect the market texture to be like tomorrow. I understand you said that you're positive on the market long term, but what would tomorrow look like? Do you believe the show of support could come from Nifty, the broader end, or both would be doing well?
Both, I think. Tomorrow, I don't expect markets to see any kind of a shocker unless you have a new development on the geopolitical tension that's building up. Otherwise, I think so markets should be fine, continue to do well for themselves, inch closer to 25,000 mark on the Nifty 50, in fact 25,200, which is the upper end of the zone. For the Bank Nifty, I think 56,500 is something that can be tested. Markets will make an approach towards that Bank Nifty. And I think this broader market theme, which is playing out for some time, is likely to continue. Like I mentioned, you have a lot of these sectors which will participate, and that's likely to continue. Names like pharma, names like banks, names like real estate, and your defense.
Okay, so that's the take coming in on what the market breadth could look like tomorrow. But on that note, Kunal, Nishchal, as well as Aditya, thanks so much for joining us on the show and sharing your views with us. But with that, viewers, only a couple of minutes left of today's trading session. Let's start winding down on that note. And Nifty, well, has done very well in today's trading session. 24,950 is where we are at on the Nifty. Almost a 1% uptick coming in. Similar for sensex.